Hey everyone, and welcome to another deep dive. This time we're taking a look at IDFC First Bank's third quarter performance for fiscal year 2025.
Sounds good.
We've got a pretty interesting set of documents, actually. We've got their investor presentation, which is always fun to look through. Lots of visuals in there. And then we've also got their very in-depth financial results.
That's great.
We're going to try to pull out some of the interesting bits for you. It's not always the most exciting stuff, but I think we can find some good nuggets in here.
Yeah.
So, maybe some surprising trends or something, things that investors should be paying attention to, or just, how does this affect just the average person? How is this relevant to your life?
Yeah.
And I think one of the most interesting things about IDFC First Bank is they've kind of gone through this big transition.
Absolutely.
Right.
It's really quite fascinating.
Yeah. So maybe you can talk a little bit about that. How have they changed as a company?
Yeah. So they've completely transformed themselves. They used to be all about financing these massive infrastructure projects, really big stuff. And now they're trying to become this full-service bank for individuals like you and me.
That's a pretty big shift.
It is a huge shift.
It's like going from, building bridges to, helping someone open a checking account.
Exactly.
So where do we see that reflected in what we're looking at today?
Well, if you look at their loan portfolio, back in 2018, when they were still heavily focused on infrastructure, about 65% of their loan book was in wholesale lending.
Wholesale lending. So that's like those big loans.
Huge loans to companies.
Yeah, for major projects.
Exactly. Today, that number has shrunk to just 18%.
Wow. So that's a massive drop.
It is a huge drop.
So if they're not giving all that money to these big companies, where's it going?
Well, they've really shifted their focus to retail banking.
Yeah.
So they're basically betting on individuals. In fact, mortgages have almost tripled their share of the loan book since that 2018 merger.
Okay, so that's interesting. So does that mean that they're taking on more risk? I mean, if the economy tanks, people are going to have a harder time paying back those mortgages.
That's a valid concern.
Right.
It's definitely a calculated risk on their part.
Yeah.
They're trying to tap into that growing consumer market.
Yeah.
But, they need to manage that risk carefully.
Right.
So it'll be interesting to see how that plays out in the future.
Yeah, how they balance that.
Yeah.
So they're talking in this investor presentation about how much their deposits have grown.
Yes.
Which is pretty impressive, especially considering interest rates are going up.
It is impressive. They're reporting a 28.8% year-over-year increase in customer deposits.
Yeah, that's a pretty big jump.
And what's even more striking is that retail deposits now make up 80% of their total deposits.
80%.
80%. That's up from just 27% at the time of the merger. So that shows you they're really committed to building a stable base with everyday savers.
Right. So they're not relying so much on those big institutional investors. Okay. But, if interest rates are going up, doesn't that mean they have to pay more for those deposits?
That's absolutely right.
And wouldn't that cut into their profits?
That's a great question.
Yeah.
And it leads us to what I think is the most interesting part of their Q3 results, which is this kind of profit puzzle. On the surface, their net profit is down 53% year over year.
Wow. That's a pretty big drop.
It is a significant drop. But there's a twist. Their core operating profit, which excludes their shrinking microfinance business, is actually up 32% year over year.
Wait, so how can their profit be down when their core business is doing so well?
Yeah, it's a bit of a head scratcher. Their microfinance segment, which, provides small loans to individuals and businesses, has been facing some difficulties, and that's probably dragging down their overall profits. And it's also possible that they've made some strategic investments that are impacting their short-term profitability, but could pay off in the long run.
Okay, so we're going to have to dig into that microfinance situation a little bit more.
Yeah.
But before we do that, let's talk about risk management. Are they being cautious? Are they playing it safe amidst all these changes?
Well, they've certainly taken some steps to reduce their risk concentration. They've dramatically slashed their infrastructure loans from 19% to just 1.1% of their assets.
Wow.
And they've also become more cautious about individual borrower exposure. Their exposure to their top 20 borrowers is down from 16% to 5%.
Okay, so they're spreading their bets.
Exactly.
Not putting all their eggs in one basket.
Well,
what about their overall asset quality? Are there any red flags there?
there has been a slight increase in NPAs, non-performing assets, which is something to keep an eye on.
Okay.
But if you exclude the microfinance segment, the picture actually looks fairly stable.
So it sounds like microfinance is the wild card here.
It really is.
We got to figure out what's going on with that.
Absolutely. Yeah, it's a real balancing act, isn't it?
Mm-hmm.
Trying to grow those retail loans, but also being cautious about risk.
Yeah, definitely. So are there efforts to kind of mitigate that risk? Are they working?
Well, one positive sign is that they haven't dipped into their provision buffers this quarter.
Provision buffers. What are those?
Think of them as a kind of safety net,
Hmm.
just in case some of those loans go bad.
Oh, okay. So they're holding on to that extra money.
Exactly, just in case.
That makes sense.
And their annualized credit cost, excluding the MFI portfolio, of course, has stayed pretty stable at 1.8%.
Okay, so that's a good sign, right?
It is. It suggests that their core lending business is doing okay, at least for now.
For now. All right. So we still need to unpack that whole microfinance thing.
We do.
But let's zoom out a little bit and talk about their big picture goals. They talk a lot about wanting to become this quote unquote universal bank.
Right.
So what does that even mean?
Well, they basically want to be your one-stop shop for all your financial needs. Not just loans and deposits, but, checking accounts, credit cards, wealth management, the whole shebang.
Wow, so they're really trying to cover all the bases.
They are. It's a key part of their long-term strategy.
Yeah, and you can see that in their investor presentation, too. They've got a whole section on all these new products they're launching.
It's very ambitious.
It is ambitious. I mean, isn't that kind of risky, too? I mean, launching all these new products, it takes a lot of time and money.
It does. It's a significant investment, and there's no guarantee that all these new ventures will be successful.
Right, so it's a bit of a gamble.
It is,
Yeah.
but they're hoping that it'll pay off in the long run.
Okay, so what are some of the early signs that this gamble might be paying off?
Well, they've seen a pretty big jump in their customer base since the merger. They're now serving over 38 million unique customers.
Wow, 38 million. That's a lot of people.
It is. And they've also made some impressive strides in areas like credit card issuance and wealth management. So those are all positive indicators.
Okay, so they're not just focusing on individuals either, right?
Okay.
They're also trying to grow their corporate banking business.
Absolutely. They've seen substantial growth in business banking and what they call CMS relationships, which stands for cash management services.
Okay, so that's basically helping businesses manage their money.
Exactly. It's essential stuff for any company.
So it seems like they're trying to attract both individuals and businesses, kind of diversifying their customer base.
They are. And by diversifying their customer base, they're also diversifying their revenue streams, which is a smart move.
Right. So if one part of their business isn't doing so well, they've got other areas to fall back on.
Exactly. It's all about spreading that risk.
It makes sense.
Mhm.
Now, beyond just the numbers, they're also trying to do business in a more, I guess you could say, ethical way.
Right.
They talk a lot about ESG, environmental, social, and governance factors.
Yeah. ESG is a big deal these days.
It is. Investors are really paying attention to that.
Absolutely. It's not just about profits anymore.
Right.
It's about sustainability and responsible business practices.
So is IDFC First actually walking the walk when it comes to ESG?
Well, they've been recognized for their efforts in areas like green financing, financial inclusion,
Yeah.
and employee well-being. So it seems like they're making a genuine effort.
That's good to hear. So we've covered a lot of ground here. Their transition to a universal bank, their deposit growth, their risk management strategies, their ESG initiatives.
It's a lot to take in.
It is. So what's next on our deep dive checklist?
Well, we can't forget about the digital landscape.
Yeah.
In today's world, a bank's digital capabilities are absolutely crucial.
Especially for a bank that's trying to be a leader in retail banking.
Exactly. So we need to take a look at how IDFC First is adapting to this rapidly evolving digital world.
Yeah, are they just another bank with a fancy app, or are they really embracing the digital revolution?
That's the million-dollar question.
So let's talk tech. We were just talking about IDFC First, big plans to become this universal bank. And these days, you can't really do that without having a strong digital presence.
Right. It's essential.
So are they actually, investing in technology, or are they just kind of slapping a shiny app on top of an old-fashioned system?
Well, it seems like they're taking digital innovation pretty seriously. They're putting a lot of resources into building up their digital infrastructure.
Okay, so it's not just about having a pretty app. It's about having the back-end systems to support it all.
Exactly. It's about creating a solid foundation for the future.
And what kind of things are they offering through their digital channels?
Well, pretty much everything you can think of.
Mm.
Online banking, mobile payments, digital lending platforms, personalized financial management tools, you name it.
So they're trying to make it possible for people to do all their banking online if they want to?
That's the goal. They want to cater to those customers who are increasingly comfortable doing everything digitally.
Yeah, it makes sense. But how do they compare to those, fintech companies, the ones
Yeah.
who were born in the digital world?
That's a good question.
Hmm.
It's a tough market out there. Lots of competition.
Yeah.
But I think IDFC First is actually in a pretty good position. They're learning from the fintechs,
Hmm.
embracing things like agile development and really focusing on the customer experience.
Okay.
But they also have the advantage of having an existing banking infrastructure and all that experience.
So it's kind of the best of both worlds.
Yeah, they've got the stability and regulatory compliance of a traditional bank combined with the innovation and digital fluency of a fintech startup.
That's a pretty powerful combination.
It is.
All right, so taking a step back, looking at everything we've discussed today, what's the main takeaway? What's the story that IDFC First is trying to tell with these Q3 results?
I think the story is one of transformation. They're really trying to reinvent themselves as this universal bank,
Yeah.
reaching a wider range of customers,
Yeah.
offering more products and services. And they're doing all of this in a pretty challenging environment. Interest rates are going up. Competition is fierce.
Right.
So it's a story of ambition, resilience, and, maybe even a bit of audacity.
Yeah, they're definitely not afraid to take risks.
No, they're not.
So, what should our listeners be paying attention to as this story continues to unfold?
Well, I think one of the key things to watch is how they manage that shift towards retail banking.
Yeah.
They're becoming more reliant on individual borrowers.
Hmm.
So how will they handle the risks that come with that? What happens if the economy takes a downturn? Will their risk management strategies be enough to protect them?
Those are some good questions to think about.
Yeah, I think it'll be really interesting to see how they adapt and evolve in the coming years.
Yeah, absolutely. And we'll be here to keep you updated, break it all down for you, help you make sense of it all. So until next time, stay curious and keep those financial brains buzzing.